Today, I will reveal the actual secret behind Warren Buffett's success. Actually, it's not one secret, but two. Actually, they are not even real secrets. And once you hear it, it seems obviously, and you wonder why you not yourself could figure it out, why you need this pretty unknown YouTuber to tell you the truth. Before I share these insights, please make sure to like and subscribe. This really helps me out tremendously. The main secret behind Warren Buffett's success is the enormous time he spent in the market compounding his returns. I know this sounds very easy at first, but let me explain. Warren Buffett started at the age of only 10 years and he's very longevity and now way above 90 years old. So he had more than 80 years compound investment returns. What many also don't realize is that he made the bulk of his fortune well above the age of 60 years. So where most people are long retired and not working anymore. So the main fortune was made when the compounding interest curve gets steeper and steeper and steeper. Let me elaborate on this. For humans, it's very easy to understand linear relationships, but if something is exponential, this blows our mind. For example, it's quite easy to guess what 2 plus 2 plus 2 plus 2 plus 2 plus 2 plus 2 and so on is, but it's very hard for us to figure out what 2 multiplied 2 multiplied 2 multiplied 2 multiplied 2 multiplied 2 multiplied 2 is. The numbers are small in the beginning, but explode very quickly. To make matters a little bit more clear, what do you think $100 invested 100 years ago at 10% per annum? What is this amount worth today? Make a guess, pause the video, and then you will probably be surprised. The figure is way bigger than most of us would assume. It is 1.378 million. So the small amount of $100 in 100 years with only 10% interest grow very big in, yeah, I mean it's a huge amount of time, but yeah, it's still mind-blowing how this developed. If something compounds, if a little growth serves as a fuel of future growth, a small starting base can lead to results so extraordinary they seem to defy logic. The real key to Buffett's success has been that he was an investor for 4/5 of a century, as you can see from this example. You don't even have to have extraordinary stock picking skills to become extremely rich over time. The US overall market has returned about 10% per annum over the last 100 years, meaning that even without stock picking, just by buying an index fund, you would have already reached the target. No stock market analysis whatsoever needed. I ignored the fact that index funds have only been around for 30 years or something, but you get the point. Time in the market beats timing the market. Even Buffett, the master himself, admits that he has a great trouble timing the market and that it is impossible even for the so-called pros or whatever to find the right spot to get in and out. It obviously also helped Buffett that he was able to almost double the return of the stock market to become mind-blowing rich. Although I don't believe that returns like this are still possible anymore in today's information-efficient markets, this is also shown by the fact that Warren Buffett could not outperform in the last 20 years himself. But we already determined that excess returns are not necessarily needed to make investing worthwhile and rewarding, as we saw in the example made before. Furthermore, he also slightly cheats in his analysis of his own outperformance by comparing himself to the S&P 500, which is an index of only big companies. This is not correct since he also invests in small companies, which would require a different benchmark, which would make him look less glamorous. But we digress. Let's do another thought experiment to figure out how mind-blowing this overperformance is. How much do you think $100 would be worth today that were invested at 20% 100 years ago to compare to the previous 1.378 million, which were the result of the compounding interest over the same period with 10% yield? Pause briefly and make your guess. Results will probably surprise you once again. It is 8.282 billion, not million, billion. So 8,282 million. You could now argue that it is more important to achieve a high return than to be invested for as long as possible. I would answer that both are important, but unfortunately you can only control the time you invest for. The yield you achieve is mostly out of your control. The scientific community these days agrees that the market is very efficient, which means that no sustainable excess return is possible on average. This is because current prices already reflect all available information. That means all information is included in the price. Smart analysis on your part will not help you beat the market. I already know what you are thinking. But Buffett did, and so did others. True, but keep in mind, in the past, the market used to be way less efficient and alpha was easier to achieve. You should also not underestimate the influence of luck. Often people confuse luck with skill. If someone has been extraordinarily lucky with his investments, people tend to attribute this success to skill, although a huge influence might just have been luck. Consider this: millions of people try to beat the market every year, and some will get lucky and others will not. A few of them might even score as big as a lottery win. Others on the other end of the spectrum will lose everything. It is simply statistically clear that in such a game there must be big winners and losers, even if we assume that the results are only based on luck, or at least for a large extent. Warren Buffett might just be the lucky lottery winner. I personally am satisfied with the average, investing only in diversified index funds and ETFs, which I would also advise everyone to do. I do not stock pick and try market timing, although I could consider myself qualified to do so, because I am a studied economist and regularly inform myself about the stock market and investing. Nevertheless, I do not presume that I can beat the market, because even the so-called professionals, namely institutional investors, hedge funds and pension funds, do not manage to achieve this goal regularly. This has been proven time and time again in studies looking at this topic. If even professionals with big budgets, analyst teams and supercomputers at their disposal can't do it, I think I can save myself time and effort trying. Warren's skill might be investing, but his secret is time. That's how compounding works. The problem is that compounding is not intuitive. We might ignore its potential and focus on the wrong things. Let's move on to the second secret of Buffett's success. Patience. No excessive risk taking. As the stock market is basically a plus EV casino, people get greedy and try to get rich very quick instead of steady and slowly like Buffett did. They take on leverage, for example, in order to multiply potential gains. This works very well in upcycles, but can be detrimental in downturns. If you operate without leverage, you can simply wait out recessions. This doesn't work when operating on leverage. Let's assume a 2x leverage, meaning you double the money if the market goes up by 50%. If that sounds great, think about the downside too. If the market goes down 50%, you are broke. You can't wait for a recovery. Your capital just evaporated.
And it's gone.
What?
It's gone. It's all gone.
What's all gone?
The money in your account, it didn't do too well. It's gone.
It's not just about patience and not over-leveraging. In my eyes, it's also about diversification, although Warren Buffett might disagree with me in this point, as he is a well-known stock picker. The thing is, if you invest in just one company, you might lose all your funds if the firm goes bankrupt. If that happens, you cannot compound yields anymore. I mean, even if you are a great analyst and on average find better firms than other people's do, and you should expect a better return, things can go south very quickly. I mean, everyone is wrong sometimes, and then you might lose a lot of money if not being diversified. You have to go back to the start and start from zero again in the worst case without diversification. This will not happen to the whole market, and if it does, you probably have way bigger problems than your money being gone. Diversified ETFs are the key for building wealth and your money to never stop compounding, making you rich in the process. But it takes time and patience and cannot be done overnight. Do you agree with my findings? Let me know in the comments below. That was it. Don't forget to like and subscribe. Watch one of these videos next to learn either about Warren Buffett's misconceptions or learn how everyone can take investing in their own hands by investing in index funds and ETFs